Okay, let's dive right in. We've got a really fascinating puzzle on our hands today. One of the biggest banks in North America, TD Bank, is posting some seriously impressive numbers. But when you look at what the experts are saying, well, that's where things get interesting. So let's start with the good news. TD just dropped its first quarter results, and get this, adjusted earnings per share are up 21% from a year ago. That's a huge beat, the kind of number that usually gets investors really excited. With a 21% earnings beat, you'd expect a glowing review, right? A strong buy recommendation, maybe? But nope, that's not what happened. Despite that fantastic performance, the analyst report we're looking at today comes to a very different and very blunt conclusion. That's it. One word: overvalued. Even with a 21% jump in earnings, the bottom line from the analysts is that the stock simply costs too much. And this is the heart of our mystery. So how in the world does that happen? How can a company perform so well, yet its stock be considered a poor value? That's what we're going to unpack. We'll dig into the two very different stories playing out inside this banking giant to understand this contradiction. First up, the winning quarters puzzle. As we've just seen, this great news is actually creating a bit of a headache for investors. To solve this, we've got to look at the bank's foundation, and that brings us to Section 2, TD's Canadian Fortress. This is absolutely key to understanding why, at its core, this is such a great company. To really get a grip on TD's strength, analysts use this really cool concept called an economic moat. Think of it as a company's unique built-in protection against its rivals. Essentially, an economic moat is what keeps a company's profits safe from being chipped away by competitors. And for TD in Canada, this moat isn't just wide, it's deep, and it's probably filled with crocodiles. And this slide really shows you where that moat comes from. First off, the Canadian banking system is basically an oligopoly. You've got the big six banks controlling over 90% of the market. Plus, you know how much of a pain it is to switch banks, right? Customers face these high switching costs, so they tend to stay put. All this gives TD this huge, stable, and super profitable customer base. And this chart right here shows just how critical that fortress really is. Look at that. A whopping 55% of the bank's entire revenue comes from its Canadian operations. I mean, this is the engine room of the whole company. So here's the bottom line. As this report points out, TD isn't just a player in Canada, it's a dominant force. For almost any banking product you can think of, they're number one or number two. It's an unbelievably powerful and protected position. But, and this is a big but, that's only half the story. All right, now for the other shoe to drop. Trouble down in the United States. Because while the Canadian business is a fortress, the US side of things has run into some very, very expensive problems. And here's the heart of the issue. The bank got tagged for some serious failures in its anti-money laundering programs. You know, the systems that are supposed to stop financial crimes. Well, TDs just weren't cutting it. The fallout from that? It was massive. Regulators came down on them like a ton of bricks, hitting the bank with a fine of $3.1 billion. That's billion with a B, US dollars. Now, that's a number that'll get anyone's attention. But believe it or not, the pain didn't stop there. Okay, so the fine was just the start. TD had to go out and hire over 700 new anti-money laundering specialists, which sent their expenses through the roof. But the biggest hit? It's that last point, a regulatory asset cap. I mean, think about what that means. Regulators have literally told TD, you cannot grow your US business. Their expansion in a super important market is completely frozen until they get this mess cleaned up. So you end up with this wild contrast, right? A tale of two businesses. On one hand, you've got the Canadian side, that wide moat, dominant, stable machine. And on the other, you've got the US business, which is just dealing with higher costs, intense regulatory heat, and worst of all, its growth is legally capped. This brings us to the final piece of our puzzle, Section 4, Price versus True Value. How do analysts take these two completely different stories, the Canadian fortress and the US mess, and boil it all down to a single stock price? To do that, they use a tool called the Fair Value Estimate, or FVE. Now, this isn't the stock price you see on your screen any given day. It's what the analyst calculates the company is actually worth once you factor in all the good stuff like that Canadian moat and all the bad stuff like the US asset cap. And this chart, well, this is the big reveal. Right now, the market is pricing a share of TD Bank at around 133 Canadian dollars.
but the analyst's fair value estimate, what they think it's really worth, is only $115. That is a pretty big gap.
Here's another way to slice it. The price to fair value ratio is 1.16. What that means is the stock is trading at a 16% premium to what this analyst believes it's truly worth based on its long-term potential. And that, my friends, is why the final verdict is overvalued. So let's pull this all together with the final verdict. The bulls versus the bears. You've got the optimists and the pessimists, and they're both looking at the exact same company but seeing two totally different things. The bulls, right, the optimists, they're laser focused on that incredible Canadian fortress. They argue it's so strong it can just power through the US problems. But the bears, the pessimists, they just can't look past all those headwinds. They see the high costs and that growth cap in the US as a major drag on the company for, well, who knows how long. And this brings us full circle, right back to where we started. The analyst's final word is that even with that awesome 21% earnings growth, the fundamental story hasn't really changed. The US problems are a serious long-term issue, and one great quarter doesn't suddenly make the stock worth its sky-high price. And that leaves us with the ultimate question for any investor, doesn't it? We know TD is a fantastic company with that powerful Canadian moat, but the market knows that too, and has priced it to perfection, and then some. So is paying that 16% premium for a quality company a smart bet, or is it a risk that's just not worth taking?